we're as optimistic about Bitcoin as we ever have been. There are a few regulatory and tax uncertainties, and we had been waiting for the discount between GBTC and NAV to narrow. It was as high as 50% at one point last year when there was great uncertainty around all of the turmoil in crypto generally. And now it's single digit. And there are now other products out there that we can use to gain exposure to Bitcoin in this moment. And it's just a moment of uncertainty between now, we think, and January 8th to 10th, somewhere in that range, perhaps. But we, out of an abundance of caution, didn't want to take any risk.
Because we're talking about the ARK Next Generation Internet ETF. The ticker there is ARKW. And I think what caught a lot of people's attentions is that you completely sold down your remaining stake of the Grayscale Bitcoin Trust. Instead, on the same day, you bought into the ProShares Bitcoin Strategy ETF. Of course, that tracks Bitcoin futures. It doesn't actually hold the physical Bitcoin. Can you explain that shuffle? What was the thinking there?
Sure. A couple of things. First of all, BITO, the ProShares, is already approved. There's no regulatory uncertainty having to do with it. So we chose to maintain our exposure through BITO for the time being. And as I mentioned before, there are some tax and regulatory uncertainties still as part of this process. We don't know exactly who's going to be approved and whether they've met all the criteria that the SEC has put before us. We know we have, but we don't know if others, including GBTC, have. We just don't know. So again, out of an abundance of caution, and GBT's discount, again, it was as much as 50% relative to NAV. So not only have we enjoyed this year the run in Bitcoin itself, but we've had the nice closing of that discount. So it's been, double good news for us.
But you've talked about January 10th, Kathy, I think in another report. Is that possible, whether it's you or somebody else, in terms of the first spot Bitcoin ETF actually getting approval?
Well, we think the probabilities have gone up because the SEC has been highly engaged compared to what was happening before. Before, it was just denying approval. And we just kept putting our filing in again, try,
Yeah.
Dogged and determined. We're first in line, and that's why there is this January 10th deadline. But we like the idea that the SEC has been so engaged, and it's not just with us, it's others as well. We think a number of funds could be approved at the same time. And they've been asking not only one set of questions, but follow-up questions. And again, that's a very good sign.
Well, speaking of engagement,
the last few questions have been very technical. And so more de rigueur, and you'd expect them to be asking these questions as we head toward an approval. Now, it's not 100% certain, and so we want to make that clear as well. This is the SEC, and we never know, what might happen along the way.
Regulators can be tricky, that's for sure. Let's talk about engagement with your funds overall, and especially the ARK Innovation Fund, up 72% year to date, easily outperforming some of the major market benchmarks. Still down 65% from the high back in February of 2021. For you, though, a lot of critics. We bring up your name, we bring up ARK, and you have a lot of fans and you have a lot of critics. There's a lot of discussion. Does it feel, though, a little bit like a victory lap this year?
We are very happy that a couple of things have happened. That this idea that interest rates were going to continue moving higher has been proven incorrect. And I think even the Fed, while there is that small possibility, even the Fed is now starting to talk about the other side of the interest rate move. And so I do believe all we've seen so far is a reaction to that macro phenomenon or judgment call. We went through our flagship strategy, and all of our strategies went through a very difficult time from February 21 through December of 22. as interest rates, first of all, were presumed to move up or forecasted to move up. And then when they did move up, so it was almost like a double discounting. And so we've seen the first installment of the correction there to the upside for our funds with this notion, and it's again the forecast that interest rates will come down. We would presume that if they do come down, for the reasons we think they're going to come down, the most important one being deflation, then our funds will be in good shape because we are very, our companies thrive on deflation. Technologically enabled innovation is deflationary.
So, Kathy, a very good morning to you. It's Manus, first time we've met on. So we're going to move to a deflationary environment. We'll come back to the big macro call in a moment. Just let's square it away before I talk to you about the flows in the funds, which is how much interest rate cuts do you presume are you forecasting? Leave the forecast of everybody else aside. What do you presume will happen next year?
Well, we put up a chart in the Employment Friday, and in that chart you will find a ratio. It's the metals to gold ratio, so metals price to gold price. And there has been an extremely tight correlation between that ratio and long-term interest rates. In October, we published it, or early November. And what you will see is that there was a very wide gap that had developed. The metals to gold ratio was near its low for the past 12, 15 years. And interest rates were at their highs, 5%. The correlation, if you just eyeballed that chart, the correlation suggested that rates should go to 2%. Now, maybe they won't go all the way to 2%, but we think that long-term interest rates are way above where they're going to end up because of deflation.
I've got to ask you about the flows into the funds, which is obviously, you know, as Carol just said to you, you've got a bit of a victory lap going on at the moment, but this is the first year of outflows. Have those outflows stopped? You've had a great performance in the back part of this year. Have the outflows stopped? And has that bleed stopped?
Yes, well, we were very gratified at our asset retention. We had net inflows, if you combine both years, of more than $18 billion. And this year, one might expect that those who average down into the very steep declines that we were seeing in 22 especially, might take some profits. So we have had, I know for our flagship strategy, it's roughly $500 million in outflows, maybe for all of our strategies, 1.8 million. So maybe 10% of the inflows that we enjoyed during 21 and 22. We're very gratified and grateful to our clients for the support that we continue to receive.
So has the outflow stopped?
We have had days of, on balance, very recently, yes. And I think part of this is many people do tax management toward the end of the year. And so some of the outflows might have been associated with clients who got in at a high cost base and were just harvesting some tax losses. But I think we're through that.
Do you find it a little surprising, though, Kathy, considering the run-up? Or I'm curious about the conversations you do have with investors, considering the year that you're having, and then to see those flows. It's got to be a little disheartening.
You know, actually, we put out a piece for Resolute, our distributor, who, and we basically showed to them, if you rebalance our strategy, when there have been big moves one way or the other, if you rebalance regularly or based on a rule like when the fund's up 15% relative to everything else, take some profits. And what it showed, that study showed, that if you are disciplined that way, that over any rolling 5-year period, it is highly likely, almost 100%. I'm not quite sure if it's quite that high, but that you will beat the market, meaning as measured by the NASDAQ or the S&P, over a rolling 5-year period. And so a lot of our funds are with advisors who are very sophisticated and responded somewhat, perhaps in this tax management part of the year, to that message.
I feel like we have to talk about Tesla and Elon Musk. And I know you just had a conversation on Twitter X. This has been, I think, from day one, right, in terms of you starting out, that you've had this investment in Tesla. And I remember when we first talked and you were getting started, you talked about him being the next Thomas Edison and how his vehicles would turn the U.S. economy upside down. Having said that, there's an evolution and the EV world has changed. How are you thinking? It's still a top holding. How are you thinking about the Tesla story right now?
Actually, I think even more closely to what we expected, because we expected a lot of traditional auto manufacturers to see the writing on the wall and rush as quickly as they could into scaling big time into electric vehicles. And what has happened recently? Both GM and Ford have said, we're stepping back. We're not going to do this until it's profitable. The problem with that is, in order to be profitable, they need to scale. That's how this works. These are learning curves that they are riding down, and those are expressed in cost decline. So the fact that they're pulling back means there's more share for Tesla and others who choose to go for it.
I want to keep the conversation going on Elon Musk, but I want to bring it to the ARK Venture Fund. You invest in private companies, et cetera, in there. And you take a look at the portfolio, you have SpaceX in there, and you also have X, formerly known as Twitter. And in July, you had told the Wall Street Journal that you had written down your Twitter stake by 47%. Fill us in on the past couple of months. Have you written it down further, or how has that changed?
No, I think it's still there. We have to be very careful. This is an interval fund. It is a 40 Act fund, and we have to market every day. The good news is our clients can get in and have access to these amazing companies for just $500, and they get quarterly liquidity. So that's the good news. The markdowns are simply, if we see in the secondary market employee stock trading at a steep discount, we have to take that into account. If we see others in the more traditional asset management world, like Fidelity and others, marking their holdings down, we need to take that into consideration during our daily mark-to-market. So it's an abundance of caution. We have a 5-year investment time horizon. Do we think that's where X belongs in terms of valuations? Absolutely not. Absolutely not. A roughly $20-ish billion valuation for what we believe truly will become the everything app. Think WeChat Pay. Elon started his entrepreneurial career in the payments industry, and he's been thinking about this for a long time. He now has money transmitter licenses in more than half of all of the states, which we learned on Twitter Spaces, or on X Spaces, I should say, the other day when we had our interview with him. So that's exciting. He's going for it.
But let's talk a little bit more about the private markets, because obviously the private credit market has gotten a lot of attention right now. You're looking at the private markets through this interval fund that you have. When you think about the opportunities there on that 5-year horizon that you have, do you see more so in the public markets or in the private markets right now?
Now that we've had this very nice run this year, we think the answer to that question is in the private markets. They're close. They're close. What's fascinating to us is that the public markets have been leading the private markets for the past 3 years. As our funds were falling in 21, private valuations were going to all-time highs, along with the NASDAQ. They were taking their cues, I suppose, from the NASDAQ. But real innovation, if you looked at our portfolios, was starting to revalue to the downside, and even more so in 2022. We are still seeing major down rounds taking place in the private markets, and I'm always surprised at this sort of thing, because you would think that the private markets lead the public markets. That has not been the case in the last few years.
I think whenever we think about Elon Musk, brilliant, but also erratic.
So, I mean, obviously, Coinbase is one of your key holdings. We've talked a little bit about that. Feature that we want to talk about is AI. I'm curious to know, in OpenAI, the valuations have ranged between 80 billion to 100 billion. Will you take a position in OpenAI? Is that going to be part of your holdings as you explore the next development of AI in your holdings?
Well, in our private portfolios, we exposed to Anthropic, which has been a major beneficiary of the drama around OpenAI that we all witnessed a few months ago. But if you look at GPT-4, which is the latest large language model that OpenAI has published, it is way above others in terms of performance. So there you have it, the pros and the cons. Mm-hmm. So we can't tell you what we're going to do in that portfolio, but we are so impressed at how OpenAI has led the industry. We're also impressed, however, at the open source models, and we'd like to encourage more of that movement. We know that Meta Platforms has with Llama 2, and it's working on others, is moving very quickly and making great strides. So for much lower cost, open source is free, companies can get close, not right at GPT-4, but close. So we want to see the open source movement in the venture fund.